Let's dive right into this explainer. Today, we're unpacking a financial journey that pretty much everyone faces at some point, making that massive leap from just hoarding your cash in a savings account to actually building real wealth. Picture this, right? You finally do the quote-unquote responsible thing. You start saving your money every month. You move a little bit over into your savings account, maybe $100 here, $200 there, and honestly, you feel great about it. You feel disciplined, responsible, financially mature, but then you hit a wall.
Imagine feeling all that incredible financial maturity after diligently saving up, say, 10 grand, only to check your banking app one day and realize something super frustrating. At a typical 0.5% interest rate, your money is basically just sitting there gathering dust. You've earned a pitiful $50 in an entire year. Meanwhile, you go online and you keep hearing everyone else talk about investing, stocks, index funds, compound growth, and suddenly it hits you. You start wondering, wait, am I doing this wrong? Because look, saving money is a good thing, absolutely. But saving alone? It rarely builds real, life-changing wealth.
Saving is crucial, but as this brilliantly lays out, protecting your money and growing your money are two entirely different jobs. Think of savings as your shield. Its whole purpose is to protect your money from disappearing. But on the flip side, we have investments. That is your engine. Its only job, literally its sole purpose, is to grow your money. A lot of folks get stuck right here because they think saving is the finish line. It's really not. It's simply stage one.
To really wrap our heads around the math here, and why we absolutely need both that shield and that engine, let's look at historical stock market returns. Take the S&P 500, which tracks the largest companies in the US. Historically, it's returned an average of around 10% per year over long stretches of time. So if that same $10,000 you saved earned 10% annually instead of a measly 0.5%, after 1 year you'd have $11,000. Now, I know, a $1,000 difference might not seem earth-shattering right out of the gate, but we have to stretch the timeline out to see where the real magic happens.
Just look at this. This is the sheer cost of playing it safe over 20 years, and it visually proves why saving alone is a losing long-term strategy. That $10,000, left in savings at a generous 1% interest rate, grows to just about $12,200 after 2 full decades. But, and this is the crazy part, that exact same $10,000 invested at a 10% return absolutely skyrockets to roughly $67,000, right? It is the exact same starting money, but a totally different outcome. The biggest wealth gap out there isn't usually between people who save and people who spend. It's between people who save and people who invest.
So, naturally, you have to ask, if the math is that obvious, why doesn't everyone just do it? Well, the barrier isn't the math, it's psychology. We all know the math makes sense, but we get stuck because investing feels emotionally risky. You know, when your money sits in a savings account, it doesn't move. You can log in, see it, and it feels perfectly safe. But investments, they bounce around, they fluctuate. And let's be honest, people are absolutely terrified of their hard-earned money dropping 5% on a random Tuesday afternoon. That emotional volatility is what scares people away from ever taking the leap.
Actually, think of it through this analogy. It's pretty much perfect. Saving is like storing a bunch of seeds safely in a glass jar. Sure, you have total protection. The birds can't get to them, the rain won't wash them away, but inside that jar, nothing is ever going to grow. Investing, on the other hand, is like taking those seeds out and planting them in the soil. At first, it's messy. You don't see any results immediately. You might even panic and think, oh no, I ruined them! But eventually, with a little time and patience, they flourish into something way bigger and stronger than what you started with.
So the real question is, how do we bridge that gap? How do we transition our mindset to take those seeds out of the jar without losing sleep? Well, we do it by following a really straightforward, totally non-intimidating 5-step framework. Emergency fund, mental buckets, start small, simple investments, and consistency.
All right, let's kick things off with step 1, build a real emergency fund.
Listen, before you invest a single dollar, this step is absolutely non-negotiable. You need to save 3 to 6 months of living expenses and keep this money in cold, hard cash, right there in your savings account. This is not your investing money. It is strictly your moat for unexpected life problems, a sudden job loss, a blown transmission, a surprise medical bill. Why is this so crucial? Because the absolute #1 reason people lose money in the stock market is that they panic sell their investments when they suddenly need cash. A fully funded cash reserve protects your investments from the wild unpredictability of your own life.
Moving right along to step 2, separate saving from investing.
This step requires a major psychological shift, but it will dramatically reduce your financial anxiety. By defining your cash into two totally separate mental buckets, you give yourself incredible peace of mind. Bucket 1, that's your safety money. It stays perfectly still in your savings account. Bucket 2 is your growth money. By explicitly giving this money a different job title, you're intentionally giving it permission to go on a roller coaster. It's allowed to ride out the market's natural ups and downs because its only job is to build wealth over a long timeline. Seriously, this simple mental separation is the ultimate secret to sleeping soundly at night while your money is invested.
Okay, next up is step 3, start investing small.
Now it's time to actually put some money into the market. And let's just completely shatter the myth right now that you need thousands of dollars or some master's degree in finance to get started. You really don't. The goal at this stage is just building the habit, not making massive profits on day one. So many beginners freeze up because they think they need this massive lump sum to even play the game. Lots of platforms today let you start with just 50 or 100 bucks because early on, establishing the physical, consistent discipline of investing matters so much more than trying to perfectly time the market.
Which brings us to step 4. Focus on simple investments first. Consider this a giant warning sign for beginners. Please avoid the complicated stuff at first. No day trading, no confusing options, no high-stress crypto speculation. Instead, focus on simple, honestly kind of boring strategies, like index funds. An index fund just tracks the overall stock market. So instead of trying to guess which one single company is going to be the next big thing, you're buying tiny little pieces of hundreds of companies all at once. It gives you instant diversification and way lower risk. It's a method so incredibly reliable that even legendary investor Warren Buffett consistently recommends it for basically everyone. In investing, boring is usually good.
And finally, step 5, consistency and compounding.
This is where we unleash the most powerful investing force in the universe, and it is genuinely crazy to look at. Let's say you invest just $300 a month into the market for 25 years, getting an average 8% return. Your actual out-of-pocket contributions, the money you physically transferred from your paycheck, totals just $90,000. But look at this breakdown. The total value of the account is roughly $285,000. That means a staggering $195,000 of that pie is pure compound growth working in your favor. That is literally your money going out into the world, putting on a hard hat, and making more money for you.
Now, I know exactly what some of you are thinking right now. You're sitting there going, okay, this sounds great and all, but what if I start doing this and the market just completely crashes? And hey, it's a totally fair question. Market crashes are completely normal. They've happened dozens of times throughout history. But here is the key insight you have to remember. Experienced investors, they stay totally calm because they think in decades, not days. They know that a market downturn simply means your regular monthly contributions are now buying more shares at lower prices. It's exactly like walking into your favorite store and seeing that everything you already buy is suddenly on a 20% off sale. You wouldn't run out of the store screaming in a panic, right? You'd buy more. Viewing market dips simply as a chance to buy the market at a discount is literally what separates successful, wealthy investors from stressed-out gamblers.
To wrap up this explainer, I want you to remember this really profound distinction from our source material today. Saving money gives you stability, but investing gives you freedom. The stability of saving is just the first threshold. It's the shield. It keeps you safe from the storm. But actually stepping over that threshold into investing, that is what unlocks true financial freedom. The earlier you combine both of these elements, the shield and the engine, the more unstoppable your financial future becomes.
So, as you reflect on this step-by-step path we've walked through today, I really want to leave you with a question to chew on. Ask yourself honestly, where do you currently stand on this journey? Are you still strictly in the saving stage, just safely building up that jar of seeds? Or have you already started getting your hands dirty and planting them by investing? And more importantly, what's one small $50 step you can take today to start turning your savings into real, lasting wealth? Thanks for exploring.